Let's talk about China's debt, an eye-watering 30 trillion yuan, or about $4.2 trillion. That's a number so massive, it's hard to even imagine. To put it in perspective, it's more than the entire GDP of some major countries. This mountain of debt has been quietly growing, lurking in the background of China's rapid economic rise. But this isn't just a big number on a spreadsheet, it's a crisis that's been quietly ballooning for years, threatening to shake the very foundations of China's financial system. Local governments have borrowed heavily to fund ambitious infrastructure projects, new cities, and massive developments, many of which now sit empty or unfinished. Now, a top Chinese think tank is proposing a bold fix: have Beijing take on local government debt by issuing special bonds. This would mean the central government steps in, taking responsibility for the risky loans that local governments can no longer manage. Imagine the central government swooping in to pay off all the risky local debts with one giant low-interest loan. It's like a financial rescue mission on a national scale, designed to prevent defaults and restore confidence in the system. This could either stabilize China's economy, giving it a much-needed lifeline, or it could unleash new risks by piling even more debt onto the central government's balance sheet. The stakes are incredibly high. Why does this matter? Because when China's economy stumbles, the world feels it. From your smartphone prices to global markets, China's growth is sputtering, and its role as the world's factory means any slowdown sends shockwaves across the globe. Its property market is in freefall, with countless unfinished buildings and stalled projects casting a shadow over the economy. Consumer confidence is at rock bottom, as people worry about jobs, falling home values, and the future of their savings. The government faces a critical choice: stick with failed piecemeal fixes that haven't worked so far, or go all in with a massive intervention that could change the course of China's economy for years to come. The world is watching closely to see which path China takes, because the outcome will ripple far beyond its borders, affecting economies and lives everywhere. Meet the local government financing vehicles, or LGFVs, China's not-so-secret financial operatives working behind the scenes. These entities might sound obscure, but they play a starring role in one of the world's most dramatic economic stories. Think of them as the shadowy middlemen of China's debt drama, operating in the gray areas where official rules and economic necessity collide. For years, local governments in China faced a big problem. They weren't allowed to borrow money directly from banks or investors, but the need for rapid development was overwhelming. So they got creative, setting up LGFVs to borrow on their behalf, sidestepping the rules while still getting the cash they needed. These LGFVs borrowed staggering amounts to fund massive infrastructure projects, bridges that spanned entire cities, highways that stretched for miles, and stadiums that dazzled the world. The hope was that these projects would pay for themselves, but in reality, many were built more for show than for profit. For a while, the system worked. Booming land sales brought in huge revenues, keeping the debt machine running. Local governments sold land to developers, using the proceeds to pay off old loans and start new projects. But beneath the surface, cracks were forming. When China's property market crashed, those land sales dried up almost overnight. Suddenly, LGFVs were left with mountains of debt and no way to pay it back. Projects stalled, construction sites went silent, and the financial lifeline was cut. What was once hidden in the shadows erupted into a full-blown crisis. Local governments faced the real possibility of default, and panic began to spread through the financial system. The financial Jenga tower, built on risky borrowing and fragile promises, started to wobble dangerously. Each missing payment threatened to bring the whole structure crashing down. Now, local governments are running out of cash. The debts they managed to hide for years are finally coming due, and there's no easy way out. The LGFV's borrowing spree has left China's economy exposed to risks it can no longer ignore. Investors are nervous, businesses are anxious, and uncertainty hangs over the entire financial system. The system that once fueled China's spectacular growth is now a ticking time bomb, counting down to an uncertain future. The big question now: can Beijing step in and defuse this crisis before it explodes, or will the fallout be too much to contain? The stakes couldn't be higher. What happens next won't just affect China. It could send shockwaves through the global economy, impacting markets and livelihoods around the world. This is the debt crisis no one can afford to ignore. The world is watching, and the outcome will shape the future for years to come. Not all debt is created equal in China. The country's financial system is a complex landscape, And understanding its risks means looking beneath the surface. There's explicit debt, official, on the books, like a mortgage or a business loan that everyone can see. These are the numbers reported in government statistics, the debts that banks and regulators track closely. By the end of 2023, China's explicit debt stood at about 40 trillion yuan. That's a staggering figure, reflecting the scale of the world's second largest economy and its appetite for growth. But the real danger lies in implicit debt, the off-the-books IOUs quietly racked up by local government financing vehicles, or LGFVs. These are debts that don't show up in official tallies but still must be paid. Estimates put this hidden debt at 70 to 90 trillion yuan, double or even more than the official amount. It's a shadow financial system operating alongside the visible one. It's a murky web of obligations spread across thousands of entities with little transparency or oversight. No one knows exactly how much is owed, or to whom. Beijing has tried to rein it in, but it's like playing whack-a-mole. Every time one loophole is closed, another seems to open elsewhere. The implicit debt is a giant, unpredictable variable that could trigger a financial crisis if defaults start to spread. The risk is systemic, threatening not just local governments but the entire economy. That's why the Tsinghua University proposal matters. It aims to drag this hidden problem into the open and deal with it head-on before it spirals out of control. The challenge is enormous, involving tough choices and potential pain for local governments and investors, but ignoring it is no longer an option. The world saw what hidden debt did in 2008, how it brought down banks and economies. China's version could be even bigger, with global consequences. The time bomb is ticking. Every day that passes without action increases the risk of a sudden shock. The question now is clear. Will Beijing act decisively before it's too late, or will the hidden debt crisis catch everyone off guard? Enter the Tsinghua University proposal, a financial shock and awe campaign. The plan? Have Beijing issue 30 trillion yuan in special long-term bonds. This isn't a tweak, it's a full-scale intervention to overhaul China's debt landscape. The money would be used for three things: cleaning up LGFV debt, buying unsold homes to stabilize the property market, and putting cash in consumers' hands to boost spending. It's a radical shift from Beijing's usual cautious approach. Past efforts were band-aids. This is open-heart surgery. The proposal signals a potential pivot toward aggressive stimulus. It's a call to stop worrying about water damage and start putting out the fire. The big question: is Beijing ready to act? The world is waiting for an answer. The stakes couldn't be higher. How would this plan work? At its core, a massive debt swap. Beijing would issue 30 trillion yuan in safe, low-interest bonds. The proceeds would pay off the risky, high-interest LGFV debts. The toxic debt disappears, replaced by stable, long-term government debt. The overall debt doesn't shrink, but it becomes far more manageable. Next, the government would buy up millions of unsold apartments, converting them into affordable housing. This would stabilize property prices and help struggling developers. Finally, direct stimulus, vouchers or cash, would go to consumers to jumpstart spending. The goal: clean up the past, stabilize the present, and spark future growth. It's a sweeping plan to reset China's economic engine. But can it deliver on its promise? The world is watching. Why the urgency? Because China's old growth model is broken. The property market has crashed, local government revenues have dried up, and debt payments are coming due. Previous fixes, like refinancing bonds and targeted bailouts, were too little, too late. Local governments are slashing services and delaying salaries. The debt pile keeps growing, and economic confidence is evaporating. China risks falling into a balance sheet recession, where everyone hoards cash and the economy grinds to a halt. That's what happened to Japan in the 1990s, and China's leaders want to avoid a lost decade. The Tsinghua Plan is a last-ditch effort to break the cycle. The risk of doing too little now outweighs the risk of doing too much. The clock is ticking. If Beijing pulls the trigger, the upside could be huge. Local governments would get relief, freeing up cash for vital services and averting a wave of defaults. Cleaning up LGFV debt would restore their ability to invest, hopefully more wisely this time. Buying up unsold homes would put a floor under the property market, restoring confidence. Direct stimulus could unleash pent-up consumer demand, jolting the economy back to life. The plan would shift risk from fragile local governments to the stronger central government, It could end the era of shadowy LGFV borrowing and bring stability to China's finances. A successful rescue would send a powerful message to global investors. China can manage its challenges. In the best case, it's not just a bailout, it's a reset. The world needs China's recovery as much as China does. But this plan is no magic bullet. It's a massive gamble. The debt doesn't disappear, it just moves to Beijing's books, raising national debt and global concerns. There's a risk of moral hazard. If local governments expect bailouts, what stops them from repeating past mistakes? Without deep reforms, today's rescue could set up tomorrow's crisis. Execution will be tricky, deciding which debts to save, valuing empty apartments, and avoiding corruption. Injecting trillions could spark inflation or new asset bubbles. Globally, China's bond issuance could raise borrowing costs and shake currency markets. The world is interconnected. China's fix could create new problems elsewhere. The plan might solve one crisis but plant the seeds for another. It's a high-wire act with no safety net. The risks are real and global. China stands at a crossroads and the world is watching. The 30 trillion yuan plan could revive China's economy or trigger new turmoil. If it works, global growth gets a boost, markets stabilize, and confidence returns. If it fails, the fallout could be global: capital flight, supply chain shocks, and financial instability. The stakes are enormous, not just for China's 1.4 billion people, but for everyone. Beijing's decision is both economic and political. The Communist Party's legitimacy is on the line. As 2025 unfolds, the world waits to see if China will unleash its financial bazooka. The choice will define China's future and shape the global economy. The next move belongs to Beijing, and its impact will be felt everywhere.